Hello and welcome to Livewire's C-Suite coverage. My name is Chris Conway. Today I'm sitting down with Gordon Bell, who is the CFO of Zip Co. He's going to be talking to us about the company's latest results and future growth opportunities. Gordon, thanks for sitting down with Livewire.
Thanks, Chris. Great to be here.
Gordon, just take us through some of the key numbers. What are the numbers that you think investors need to be most aware of from the results last week?
Look, first of all, at Zip, we're really pleased with our full year 2025 results. This year has been a defining one for Zip. We recorded our strongest financial performance in history with our cash earnings of 170.3 million, which is an increase year on year of 147%. So, a great outcome for the whole organisation. Some of the key highlights, we ticked over 1 billion in total income, and our US business, especially, which fueled a lot of the growth this year, delivered over 100 million in US dollar terms for cash earnings, which is a great milestone for the business there. Volume transaction was up. TTV or total transaction volume for us was up 30% to 13 billion. And our active customers are really pleasing results. We were able to grow active customers by 4.6% to 6.3 million active customers across the group. And I guess we've done this while we've been, I would say, very vigilant in managing our bad debts and our credit performance in what has been a pretty challenging macroeconomic environment the last 6 to 12 months. So we're really pleased with the outcome there in terms of credit portfolio. And all that comes together to deliver an operating margin result, which doubled to 15.8%. So all in all, metrics across the board were really pleasing to the Zip stakeholders.
Gordon, we'll get to the bad debts shortly, but I just wanted to touch on, again, the total transaction volume. So really incredible growth, very impressive. Can you just talk to me about which categories are fueling that growth, and then whether you think those trends are repeatable in the medium term?
We saw a lot of growth, particularly in our US business in the full year 25. Where TTV grew at just a tick over 41%, which translated to revenue at just over 43%, year on year. In the US, we serve a unique customer base, which we describe as the everyday American or the underestimated American. And we put this cohort at somewhere between 100 and 120 million. And we feel that they're underserved by traditional, financial products. It's working with that customer base, who are a very resilient, customer base and looking to manage their cash flows, day to day, that we've been able to drive, this result. One of the areas or one of the questions you asked, which really fueled a lot of that, was we saw a majority of our spend in what we call non-discretionary categories. So these are household items, insurance, bills, etc., as opposed to maybe your fast fashion online or so forth. And so, that was one of the pleasing results. We saw a lot of uptick in non-discretionary spend. We saw a lot of repeat business from our customers in those segments. I guess the last point I'd say is that we've listened to our customers in terms of product development as well. On top of our Pay in 4 product, we now have our Pay in 8 product in market, which unlocks different merchants and a higher order of spend. And we're live with our pilot on our Pay in 2 initiative now, again, to help customers vary their repayment profile depending on what they want to use it for. So all in all, it's a mix of product suitability, and spend category. Chris?
Gordon, we saw some increased expectations following events at the weekend of rate cuts in the US. How might a rate cut or rate cuts impact your growth rate? Is it a net positive?
It's a positive in two ways. The first is we look predominantly at consumer sentiment as opposed to interest rates on a sort of a primary, secondary basis. So to the extent that a rate cut provides a boost in consumer sentiment, that supports our business both in Australia, and in the US. So that's probably the real one we look out for Chris in that regard. The second one then is just in terms of the tailwind for funding costs. So we have, all of our funding is done at a floating rate basis. And so any rate cut in both the US or Australia is a tailwind for us in terms of the cost of funding our business. And so we look at both as we come into FY26.
Gordon, just talk to me a little bit more about bad debts. You mentioned them earlier, so come down from 1.7% to 1.5% of total transaction volume, and as you said, a pretty exceptional result given the macro forces. So what were the drivers behind the improvement? And again, is this something that you think is repeatable in future periods?
Yeah, Chris. So we have a target range for bad debts of sort of 1.5 to 2% of our total transaction volume. So to see the bad debts at 1.5% of TTV, which is actually the lowest in the last 2 years for us, is a great result. And it's a number of factors there. We are hyper vigilant on credit in the way that we underwrite our customers, as well as the way that we constantly appraise the markets, spend, repayment behavior, etc. So very pleased with that outcome. And we've got the settings that we feel in place to allow us to grow as well as manage bad debts through the P&L. And I'd say that's both for the US and Australia. We saw great performance in Australia on the bad debts front as well, which has been another challenging environment economically, probably lagging the US a little bit in terms of sentiment and so forth. So we're pleased with the result in both markets.
Gordon, the market always wants more, and I think they would have been pretty impressed by the fact that the FY26 forecasts show that you're still expecting pretty strong total transaction volume growth, circa 35% or more. So can you just talk us through some of the key assumptions there, and then what are the risks to that forecast?
I think it's probably important just to outline that the US market, which is the 35% plus growth rate you're referring to, it's still very early days in the US market in terms of the penetration of non-traditional forms of payment. And so with the last 12 and 24 months experience under our belt, we felt it was we were able to give a number for the coming 12 months of greater than 35% growth, whereas in the past we've looked at relationships to market growth, etc. We've got a lot of great initiatives underway to drive that growth. I mentioned one or two earlier, but we have our product innovation with our Pay in 8 and our Pay in 2 product. We've got our relationship with Stripe as an aggregator, which is going really, really well. And we've also got our innovation arm, Fearless Frontiers, which we launched as well, which is going to drive the new areas of product development and customer loyalty that will help us drive growth across the whole platform. So all in all, we feel we've got great initiatives and great momentum to drive that number in FY26.
Gordon, one of the other big stories out of the results last week and the announcement was the potential for a secondary listing on the NASDAQ, whilst of course you'll still maintain the primary ASX listing. So can you just talk us through the rationale there? And then I think importantly, how does it help with your liquidity and then the cost of capital that you were talking about earlier?
Yeah, no, absolutely. No, we're really excited in the announcement that we are considering a dual listing on the NASDAQ. And that really supports our growth opportunity and our growing investor interest in the US. In terms of rationale, our US business now represents over 80% of our divisional earnings, and Zip has also seen a lot of increased interest from US and international shareholders. Our institutional investors comprise 16% international shareholders right now, and that's growing. And so we see this as an excellent opportunity to further engage with the US investor base as well as with our US customers in terms of a dual listing. What I would say is that there takes time and there's obviously a process to go through here, and any listing does remain subject to Zip board approval. But we're looking forward to working on that and updating the market in the coming months as to how that's going.
Last question for you. So earlier in the year, you launched a $50 million share buyback. I believe about 30 million of that has been completed so far. As we were talking about, the market, now that they've seen such impressive growth, they're going to be hungry for more growth. So just talk to me about how you balance the need for capital management, capital returns versus reinvestment for growth, particularly in product innovation and marketing, as you've been talking about?
Yeah, no, that's a great question, and you're spot on with the numbers. So it was a $50 million buyback we launched in April this year, and we've completed approximately $30 million to date. Look, the buyback is fully aligned with our capital management framework, which looks to maximise shareholder return, over the long term. So looking ahead, we'll continue to prioritise preserving a strong balance sheet, which allows us to grow and allows us to develop products. It also allows us to pursue attractive growth opportunities as they arise. And we've been pretty open that we will appraise opportunities as and when they come up. And so right now we've got great opportunities through our existing business, which is one that we're going to continue investing in. So we're certainly prioritising the spend in terms of marketing, co-branding, and some of the promotion work we're doing with our existing partners, and that helps us, achieve those growth targets that I outlined earlier. And we're also looking at other opportunities, such as via our Fearless Frontiers arm, where we've got an innovation lab now to drive the next generation of product and so forth. One of the things that we're really excited about there is we've developed a money coach in the US, which is an AI-enabled coach to help customers with their profiling and their cash flow management. So that's in pilot stage, and you'll see that coming soon. So really, we look at all these opportunities and we weigh them up, and we'll make decisions which are in the best interest of our shareholders, for the long term.
Well, Gordon, as I said earlier, really impressive set of results. Congratulations to you and the entire Zip team. I know a lot of Livewire and Market Index readers are very much interested in the Zip story, and I think they'll wish you nothing but success moving forward.
No, thanks, Chris. And I'd just like to finish by saying a big thank you to the Zip shareholders and all of our stakeholders. We've obviously had a lot of fun this year delivering these results, and we hope to continue.
Fantastic. Thanks, Gordon. We appreciate you sitting down with Livewire.
Thanks, Chris. Have a good day.
If you enjoyed that C-Suite coverage, make sure to give it a like, and don't forget to check out the rest of the reporting season coverage available on the Livewire Markets website.